It is much easier to avoid falling into a hole than to climb out of one. This simple yet profoundly true statement encapsulates one of Buffett's most fundamental approaches to investing, the art of avoiding mistakes. Warren believes that often the key to financial success lies not only in making the right choices, but also in avoiding costly errors. With the arrival of a new year, it's natural for many of us to set financial goals. Perhaps it's buying stocks for the first time, boosting your investment portfolio, or even starting to save more consistently. However, many investors, whether beginners or experienced, end up making mistakes that could have been avoided with a bit more reflection and patience. Here's a challenge. Do you know which mistakes have the greatest impact on your financial performance? And, more importantly, how to avoid them before they lead to losses? He often emphasizes that it's not just about winning, but about not losing. He is known for following a golden rule. Rule number 1, never lose money. Rule number 2, never forget rule number 1. In this video, we'll explore the most common mistakes investors make and how we can learn to avoid them through lessons from Warren himself. Throughout this video, you'll discover why not following the herd can save your portfolio. Our long-term mindset is your greatest asset, what you can do to identify traps before you fall into them. And above all, we'll turn the start of this year into the perfect moment for you to align your financial decisions with the timeless principles that made him one of the greatest investors in the world. Stay with me, because what comes next may not only protect your capital, but also prepare you to seize the best opportunities in the market. Ready to embark on this journey? Let's delve into Buffett's teachings and learn how to start the year by avoiding common investment mistakes. Avoiding mistakes in investing requires more than luck or intuition. It's a matter of strategy, patience, and knowledge. Warren has always emphasized that investing is a long-term game, where the focus should be on solid decisions rather than quick or impulsive moves. Let's explore the most common mistakes investors make and how to avoid them based on his principles. One of the most frequent and dangerous mistakes is following the herd. This means investing just because everyone else is doing it. During the dot-com bubble in the late 1990s, for example, many investors blindly bet on tech startups, promising exponential growth but lacking solid fundamentals. The result: the bubble burst and billions of dollars vanished. He always advised to be greedy when others are fearful and fearful when others are greedy. The essence here is understanding that the best decisions don't depend on what the majority is doing, but on what makes sense based on the fundamentals of an investment. Before investing, ask yourself, do I truly understand why I'm buying this? Are the fundamentals solid, or am I just acting out of FOMO? Fear of missing out. Research, analyze, and don't rush into something just because it's trendy. Imagine boarding a plane piloted by someone who has never read the flight manual. Sounds absurd, doesn't it? Yet this is exactly what many investors do when they put their money into stocks or assets they don't understand. Buffett often says, risk comes from not knowing what you're doing. In the mid-1980s, Warren began investing in Coca-Cola. He deeply understood the business, its brand, and how it created value. This gave him the confidence to buy shares and hold onto them for decades, resulting in massive profits. Before investing, take the time to study the asset. Analyze financial statements, understand the market in which the company operates, and ask yourself, if I were to buy the entire company, would I feel comfortable managing it for 10 years? Many investors enter the market with a short-term mindset, expecting quick gains. This behavior often leads to impulsive decisions, such as selling in moments of panic or buying during periods of euphoria. He, on the other hand, invests with decades in mind, not days or months. He often says that the market is a money transfer game from the impatient to the patient. Patience is your greatest ally, especially during times of volatility. During the financial crisis of 2008, while many were selling stocks in panic, Buffett purchased large stakes in solid companies at low prices. He knew that crises are temporary and that markets tend to recover. Set clear goals and avoid checking stock prices daily. Evaluate your portfolio periodically, but remember that short-term fluctuations are normal. Another common mistake is overlooking the costs associated with investments, such as brokerage fees, taxes, and management fees. These expenses, accumulated over time, can erode your returns. Warren is a strong advocate of keeping costs low. He often recommends low-cost index funds as an alternative for investors who lack the time or expertise to manage individual assets. Review your portfolio and identify unnecessary costs. Opt for simple investments with reduced fees and pay attention to the tax efficiency of your strategy. While he is known for concentrating his investments in a few companies, he also understands that diversification is essential for most investors. For him, diversification is protection against ignorance. In other words, if you don't have deep knowledge about each asset you invest in, diversifying is a smart way to reduce risks. Ensure that your portfolio is not concentrated in a single sector, company, or type of asset. Invest in stocks, fixed income, and other assets that reflect different parts of the economy. These are just some of the most frequent mistakes investors make. Avoiding them is the first step to starting the year on the right foot, aligned with his wisdom. But there's still much to explore about how to turn these lessons into practical, long-term strategies. Now that we understand the common investment mistakes and how to avoid them, let's dive deeper into Buffett's philosophy. He not only avoided pitfalls, but also saw crises as opportunities, wielded patience as a powerful weapon, and had an impressive ability to identify undervalued assets. Warren has a simple yet powerful perspective on crises. They are moments when markets overreact with excessive pessimism and falling prices. Be greedy when others are fearful, he advises. For him, crises represent a broad clearance sale of high-quality assets, allowing him to buy shares in great companies at reduced prices. During the crisis of 2008, he invested about $5 billion in Goldman Sachs. He understood that while the financial sector was under immense pressure, strong institutions like Goldman had solid fundamentals. His bet resulted in substantial returns when the market stabilized. In times of crisis, stay calm and look for companies with strong fundamentals that are being sold at discounted prices. A simple approach is to create a list of companies you trust and monitor them for opportunities during downturns. One of his most remarkable skills is his ability to identify undervalued stocks, shares of companies whose market price is below their intrinsic value. He adopts an investor as owner approach, analyzing assets as if he were purchasing the entire company. How Buffett assesses value. He uses a few simple but powerful pillars. Understanding the business. He only invests in businesses he deeply understands. This includes predictable sectors like food, insurance, and consumer staples. Durable competitive advantage. He looks for companies with moats, competitive advantages that protect them from competition, such as strong brands, regional monopolies, or low operating costs. Quality management. He values competent and trustworthy leadership teams. Attractive price. Buffett invests only if the stock is trading below what he believes to be its intrinsic value. A classic example is his acquisition of Apple shares. Although Warren traditionally avoided tech companies, he recognized that Apple had a very strong moat, its brand and ecosystem of products. Today, Apple is one of Berkshire Hathaway's largest holdings. Learn to calculate intrinsic value. You should learn how to calculate a stock's intrinsic value using discounted cash flows or other fundamental analysis methods. This will give you greater confidence in determining whether a stock is cheap or expensive. He avoids speculation as if it were poison. He believes that trying to predict short-term market movements is a recipe for disaster. Investing is not a game where the guy with a 160 IQ beats the guy with a 130 IQ, he says. What you need is temperament. During the cryptocurrency craze, while many were betting on quick gains, Warren kept his distance. He made it clear that he doesn't invest in something he doesn't understand or where he sees no intrinsic value. Instead of trying to guess where the market is heading, focus on building a diversified portfolio based on solid fundamentals. This approach will reduce risks and increase your chances of long-term success. One of his most practical recommendations for ordinary investors is the use of index funds. He believes that most people would benefit more from consistently investing in low-cost funds than trying to beat the market. The best way to invest for most people is through index funds that track the S&P 500. He even instructed that his own inheritance be invested this way to benefit his heirs. Consider allocating part of your portfolio to index funds as a way to achieve consistent returns and avoid the high costs associated with managed funds. With these strategies in mind, you already have a solid foundation to start the year wisely, avoiding common mistakes and aligning your decisions with Buffett's timeless principles. However, there's still more to explore. The start of a new year brings the opportunity to redefine habits, set goals, and adopt smarter strategies. When it comes to investing, few things are more important than learning from mistakes, both our own and those of others. And no one understood this better than Warren. Throughout this video, we've explored how to avoid common investment pitfalls and adopt a mindset aligned with his timeless principles. But now it's time to synthesize all of this into a practical action plan for you to implement immediately. Let's explore a 5-step plan to put into practice today and set yourself on the right path this year, starting strong with your investments. 1. Review your portfolio. Analyze all your current investments. Were any purchased without proper analysis? Are there any underperforming without a clear justification? Adjust your strategy as needed. 2. Define your financial goals. What do you want to achieve this year? Be specific. Examples: build an emergency fund or increase my exposure to index funds. 3. Choose quality over quantity. Narrow your list of potential investments to a few high-quality assets. Focus on companies you understand and that have durable competitive advantages. 4. Adopt the habit of reading. Buffett reads an average of 500 pages per day. You don't need to start at that pace, but strive to learn constantly. Books on investing, annual company reports, and economic news can be excellent resources. 5. Implement and monitor. Put your plan into action and monitor your progress regularly, but without obsession. Review your portfolio every 3 to 6 months to make adjustments as needed. Warren teaches us that success in investing doesn't depend on complex formulas, but on discipline, patience, and knowledge. He has proven that it's possible to thrive by adopting simple and consistent principles. If you incorporate even a fraction of these lessons, you'll be on the right track to achieving your financial goals. As Buffett himself said, investing is simple, but it's not easy. There are no shortcuts to becoming rich overnight, but consistent and disciplined effort pays off in the long run. If you feel more confident about starting this year by avoiding mistakes and seizing opportunities, it's time to take action. Take these lessons and transform your financial mindset. Start small, but start today. Did you enjoy these ideas and want to learn more about achieving financial success inspired by great investors? Don't forget to like this video and subscribe to the channel. That way, you won't miss any content that could transform your perspective on finances and investments. I'll see you in the next video, and until then, keep investing in the most important asset, yourself.